Michael, thank you so much for coming.
Happy to be here.
I'm excited. I just want to jump right into it. So you launched Harvest almost 2 decades ago, and it was right in the middle of the financial crisis. So my first question is, what made you crazy enough to dive headfirst into something like that? Like, I'd love to know.
Yeah, well, you're right. I mean, the financial crisis was a very difficult time, and when you're in the middle of the forest, right? You don't really know when it's going to end. So by 2009, we were getting to the later stages of it, but you didn't know. There was a lot of issues still. There was a lot of banks in the U.S. had problems. So I had always had this idea of launching and starting an investment company, and to use John Lennon's line, "No friends, but yet no enemies." At that point, when you're launching a company, at the markets were at that point, we didn't have any performance to talk about, but we didn't have any bad performance. So it was a good opportunity to sort of go out there, take an investment philosophy that I believed in, which is really about long-term capital growth, and bring it to the market. So it was very fundamental. And I felt at that point in time, there was a lot of people that were confused about what had happened in the markets, and just seemed like a good opportunity to launch a company.
So take me back there. So when you were in that, because I know that Canada actually has and had a very good infrastructure. So I don't think we got as rocked as the United States.
Right.
So we could put that to regulation, things like that. But even in the industry, like dealing with that and coming out of that, like why do you think Harvest worked at that time? Do you think it was a very specific point in time when you guys were coming out of that and you were going into the growth, or what was it about like this environment that really made it like helped you harvest?
Yeah, right. Well, you're right. Canada did not get as hit as hard as the United States, but still a lot of our stocks were down. And at that time you could get 9% on BMO, and I think at one point 11% on CIBC. I mean, the rates, the dividends you could pick up were incredible. But getting back to the business, I had about 25 years of experience at that time, had a lot of contacts, had been in the industry my whole career. So like any business, it's your first few years are the toughest. You've got to get people's confidence. They have to believe in what you're doing. And, so I sort of went out on the road and just started talking to people and talking about the philosophy that I had and how I wanted to bring it to the marketplace. And when you get really deep into a cycle, like we had sort of at that point in time before the financial crisis, people start going up on the risk scale to get better returns.
Right.
And, the idea was let's boil it right back down to the fundamentals. Let's buy great companies. Let's buy companies that have great management and that can grow over time and are proving themselves in that current environment that they are continuing to grow. And let's put together portfolios of these types of businesses. So it's I think the hardest part is like any business going out and convincing people, like convincing in this case advisors, because that was the majority of the market at the time, to take a look at our products. And we went out there and launched our first product by October. Actually, we are October.
Yeah. Okay. Cool.
So 16 years ago.
Wow.
And raised about $25 million in the product, which was our Harvest Banks and Buildings Income Fund, which doesn't exist today.
Fair.
But the idea was you can get these great high rates in the banks. You had a lot of real estate companies that were paying out huge amounts of income as well. So we combined a fund that had hard assets and financial assets and took it to the marketplace.
So did that insight come from your career? And was it, one of those things where you're thinking to yourself, like, this is a structural wave and like, I want to be on this wave because it's coming, so I want to get ahead of it? Or was it, hey, there's a gap in the marketplace, nobody's doing something like this, or if they're doing it, they're not doing it at a high level? Like, was it more like, this is where the market's going and this is where the every sort of things are going? Or is it, hey, like, nobody's doing this, we should do this?
Well, a little bit of both. I mean, I wasn't really thinking too much of the structural side at the time because we started off as a closed-end fund company, which are structured products. But it was really just taking that fundamental philosophy and applying it to those products and growing forward. Even though today we're an ETF company for the most part,
right?
Like 90% of our business, but it's the same underlying philosophy that we're following. So the idea was, let's just get back to fundamentals.
Right.
People had been beaten up badly. People didn't really know where the market was going. And let's just take a fundamental idea to them and to see if we can get this spark going. And it did, and it worked, obviously.
That makes sense. I think it is interesting how so much innovation, like financial innovation, came out of that, right? Yeah. Whether it was regulation or whether it was new products or whether it was stuff that, I don't know. I think the financial engineering that happens these days, It's incredible. It's honestly astonishing. Did you guys feel early on that you were ahead of the curve in that manner? Or was it sort of like, hey, like I said, like this is something that a lot of Canadians need to harvest and create a sort of income source for themselves? Or was it like you guys, had an engineering team, great financial engineers and stuff like that?
Well, in those days, I mean, we excuse me, we weren't in the option market. We hadn't gone there yet because the yields were so high in the stock market because of the financial crisis. So it was really just a matter of taking that philosophy, not trying to do anything special, like no financial engineering, but to take that philosophy and that long-term approach to the markets and bring it out to, at that time, mainly advisors. And we were very small. Actually, at that time, we farmed out the investment management to outside investment managers. We didn't actually bring the team in-house until a couple of years later.
Okay.
But again, I had to actually go out and find managers as well and say, look, this is what I want to do. Here's the type of philosophy. And they're like, well, that's pretty simple, pretty basic. I'm like, yeah, but simple and basic works.
Right.
Like we get too far up that scale sometimes and get too complicated. Let's just bring it back to the fundamentals and take that to the marketplace. And it's, over time it did work.
So skipping forward a little bit, but in today's environment, a lot of investors are looking for, 8 to 10% and things like that. I guess, what are your thoughts around that? Do you think a lot of investors are too comfortable with that? And if, the market changes, I guess expectations, like where do you think expectations maybe should be, where they are, and how do you guys sort of message that to some of your investors?
Well, I wish they only wanted 8 to 9%, because that's really when we launched. Going back to your other question, we were paying out a 7-8% rate, which was very high at the time, and that was sort of a bit of a wake up call to some advisors. So we were one of the first to bring out higher yields.
Yeah.
Now the expectations are double digits.
Yeah. Well, I guess with some of the NVIDIA and stuff like that, certainly.
We've launched single stocks, as you know, they've done extremely well.
Yeah.
The expectations on those are much higher from the standpoint of yield. But if I could step back, I think that has a lot to do with investors today. If I think back even 15, 16 years ago and through my career, people really focused on market. So your stock market returns. What's your 1 year, your 3 year, your 5 year, your 10 year? A lot of advisors won't even talk to you until you get to a 3 or 5 year track record.
It's too new.
Yeah. What's changed now is people are looking at more of a total return structure. So I want to get some growth, but what kind of yield can you generate? What kind of performance is that going to derive for me over the year on a total return basis? So that's a big change that we've seen really since around the time of COVID. So that's something that we've embraced. We've got a lot more aggressive on that side. And on top of that, when bringing options into our strategy, back in 2013, that also helped us enhance those types of returns by using the option market, by selling call options.
Yeah, speaking back to 2020, I remember obviously interest rates were on the floor and it was very, you couldn't really get great stuff with bonds, and people were just looking for yield. So a lot of people would be in like dividend stocks and things like that. Did you guys experience like a huge source of growth from that period because people were looking for yield before central banks like increased rates?
Well, you're right. I mean, rates had been going down for about 25 years. And, my career, I benefited from that because as rates went down, stocks went up. And there's an old line that, interest rates are like gravity on stock markets. So as rates have popped up, stock markets came down a few years ago. But now during that time, you had interest rates dropping, stock markets were rising. So I think part of our philosophy at that time as well is, well, how are you going to grow your capital? And we're looking really at the retirement market and generate a yield. Because if you simply retire and put your money into other investments or the stock market, you're only going to get a 2 or 3% yield. If you put it into a bank account or into a GIC or whatever it is at that time, again, you're going to get about at one point 1% or no yield.
Yeah.
So
absolutely,
it was a great solution to help people grow their capital, because if you're retiring and you're possibly going to be retired for 30 years, how do you keep that capital over time and generate cash flow to live on? So that more and more was boiling down to our philosophy as a company about how do we grow capital? Well, we go own great companies. And then how do we generate income? And as stock market started to rise and those dividends rates started to drop, we embraced the option market and started to develop an option strategy to generate that additional income.
Yeah. So I think with this strategy, and I think this is probably what I'm most excited to ask you about. So obviously there's, um, it sounds fantastic, and it is. You know, you would have critics that would point out things around, you know, in a booming market, it limits upside, and then it only works in certain markets and things like that. So what do some critics of maybe some of your products have right, and what are some things that they don't have right at all?
Well, they're absolutely right from the standpoint of if you write options, you will limit your upside, especially in a very strong market. So it really comes down to the balance. How much do you write or sell calls? How much do you sell to create enough balance that you've still got the growth of capital, but you've also got higher cash flow? So we find that number to be around 60 to 65%. Sorry, unwritten. So your written part is 30 to 35%. Sometimes we go a little bit higher. Sometimes we've been down in the mid 20s. But the idea is we want to have as much long bias exposure to the underlying market. So if we're writing less to enhance the income, but we've got 60 or 65% tied to the stock market, we're going to get the growth. So they're absolutely right when they say, well, you know, if you own a stock naked, so to speak, it's going to rally.
Right.
You're going to capture 100% of that growth. If you're selling some calls on it and you're monetizing a bit of that income or monetizing some of that growth to generate cash flow, you're not going to get the full 100% upside, but you're still going to get a very nice return.
Absolutely.
And option writing, even though when markets drop, stocks drop, even stocks that have options written on them will drop. But the income helps to offset. Sometimes when you're sitting and waiting, you could be waiting 3, 6, 9 months for markets to recover. That income will help maintain that sort of position in that investment.
Yeah. Okay. That makes a lot of sense. And I think, like most things, obviously, there's way more nuance than they're good, they're bad, they're evil, they're this.
You know, and we just did a piece on options, and the whole point is options have been around a long time. They're very big, deep markets, like in the $400 or $500 billion range in the United States. Hundreds of millions of these things trade daily. I mean, it's a big market, so it's not evil. They're not all bad.
Totally.
I think if you're in a growth market and you're writing calls on 100% of a portfolio, you're going to basically lose a lot of the upside, and you will erode your capital.
Right. So it's how you structure it, like you said, with
So if you've got 30% or 35% written, so you're generating that extra income, and it can be a very attractive income, and you still got some upside on that stock. So that's part of the whole strategy. And it just takes time. There's some theory to it, but a lot of it's just the practical, and you have to sort of build that up over decades in the business. You sort of figure out how to do this.
And then, like, what's the sort of Goldilocks range for you guys and things like that.
Yeah, exactly.
So I want to go back to interest rates. So I guess, you know, everybody feels like, you know, I guess that first big rate cut is coming, and people are sort of banking on it. How are you guys thinking about the next couple of years in terms of the market sort of shifting, rates being a bit lower, a lot of maybe good inflation, maybe frothiness, things like that? How do you guys see that shaping out?
Well, we have seen one cut already in the States. We're expected probably to see another one, maybe 2 this year. We think there's going to be 2 or 3 probably over the next 12 months. So that will help markets. And I think we're seeing, here we are in October 2025. So we're seeing a very strong market. It's seasonally doing much better than it usually does in September, October.
Yeah.
I think a lot of that has to do with earnings continue to come in at a pretty good clip. Objectives are being met by these companies. And there's the thought that interest rates are going to start finally declining. If that occurs, then that's fuel for stock markets.
Yeah.
So this is all sort of playing into it. We don't make an investment decision in a company based on where interest rate's going to be. I mean, that's really more short-term noise. Longer term, if it's a great business, they will be able to cycle through up and down rates over time.
Totally. And I think a huge source of growth right now in the markets obviously is artificial intelligence.
Yes.
And, you know, I was reading something this morning around, it was like a diagram of, you know, a lot of the deals that are being announced, you know, in NVIDIA, you know, 100 billion with OpenAI, and Larry Ellison's getting involved. It feels like every tech player is spending like 12 figures, making 12-figure investments. But, you know, a lot of this criticisms is starting to be, it's quite circular, where it's like you'll have NVIDIA do a partnership with OpenAI, so OpenAI can buy more stuff from NVIDIA, or you'll have them making in different investments. And it sort of seems like they're giving money and they're getting money, or they have an equity stake, or it's Microsoft or whatever.
And they're going to build these huge tech centers.
Exactly,
and so on, right?
exactly.
Yeah.
So I guess, what are your thoughts around that in terms of like, do you like, obviously there's a ridiculous amount of excitement, and that's why markets are near, if not at all-time highs right now. How do you look at AI and some of the, tech and innovation that's coming out of that?
I think AI is going to be very accretive to society and to markets over time. I was reading, this is going back a few weeks, there was a Goldman report about they believe that AI will add 1.5% to GDP as we get out over the next 10 years, and probably 7% to overall GDP over the next 10 years globally.
Yeah.
So it is going to be a net benefit to society. But to your point, and AI fits into all kinds of things, not just logistics. It goes into a day-to-day working environment. It goes into medical sciences, all kinds of things it's going to benefit. Sorry, I lost my train of thought here.
You're good. You're good.
But I think AI is going to continue to benefit society, and all this capital investment currently, you could see that, yes, as inflationary, but I think just the longer term benefit to society will be through these investments.
And I guess, what do you sort of think about when you look at the S&P 500, for example, and it's just becoming more and more and more top heavy, where a lot of these multi-trillion-dollar companies are taking up a large amount of the weight. And then when you look at the bottom, let's say 480 companies, maybe the returns haven't been as strong. Like, are you, I guess, anxious about that at all in sense of it being top heavy? Because for me, I see a lot of the criticism, but I'm also kind of like, it's sort of how it's always been. But do you think it's getting out of line, or you think it's getting, hey, like maybe more international markets are more attractive for you guys to think about more than maybe the American market? Or
no? Well, we're still dominant in the U.S. market. We still think it'll continue to be the dominant market. And you're right, your top 7, really, a magnificent 7. But if you go beyond that, you still probably your top 20 or 30 companies are dominant in the AI space. But it is filtering down into all these other businesses, and we still remain positive on where we think markets are going to go. And we're predominantly in U.S. stocks.
Yeah.
So we do have some European holdings, we do have some Canadian holdings, but predominantly U.S. stocks. And these companies they're putting big earnings on the board.
Well, that's what I always
making big
say.
Investments, and these investments are over time. That 100 billion, 500 billion, that's over 10-year periods.
Yeah.
There's a lot of infrastructure that has to be built to support these projects.
Absolutely.
So
Absolutely.
There's a lot of work, and that's actually will create other jobs and other things in society as well.
Yeah, and I think it's interesting because I look at a lot of these companies and they'll get compared historically, and I'm like, there is no real historical comparison to how great of a business like Meta is, for example, or like Google, or like it. Like, I remember when Meta cut, I think it was 20 or 30% of their staff, and they grew their earnings like 20, 30%. Like year over year or something like that. It's like their earnings growth, like the numbers are there for these valuations and things like that. When you look at like NVIDIA, for example, I think it's at north of 4 trillion right now. I don't know what the multiple is off the top of my head. What do you think about NVIDIA in general? Do you think that they are one that is that they're going to meet the demand that they're sort of setting out with all these different partnerships? Or I guess, what are your thoughts around NVIDIA?
I think NVIDIA is going to continue to be a great growth story.
Yeah.
The work that they're doing, the partnerships that they're making. If you listen to Jensen Huang, he talks about how they were just a small little graphics company 20 years ago, and how Intel tried to put them out of business and so on.
Right. Yeah.
Well, look, they're the market leader. And there's actually been, if you sort of tear into markets, there's been companies that have actually performed better than NVIDIA, but it's just such a big part of the market.
Yeah.
And I think it will continue to be a dominant player, and they're going to continue to take the capital they have now and make those investments, because that's where they are in their sort of in the ecosystem of what they're working at in their own evolution.
Yeah.
They're sort of at that point where they've got the capital now to invest, and they can actually take, what do they invest, $5 billion or so into Intel. So they're actually investing in Intel to help them grow. And Intel tried to put them out of business. Right? It's really
like a
interesting.
Blockbuster Netflix thing. Yeah.
But if you look through history, the Nifty 50, like in the late 60s and into the 80s and so on, there's always been a group that have moved more than the others. There have been businesses that fall away, businesses that got bought out, but generally those top companies continue to dominate. I mean, even think about Microsoft. I think 5 or 6 years ago, people were sort of thinking, well, Microsoft, their big days are over, and they're sort of a software company, but no, they're making huge AI investments
Absolutely.
as well.
They're at
And
the
they
forefront of it, right?
And they continue to grow.
Yeah.
People wrote off IBM 2-3 times through my career.
Yeah.
And it's continued to be a dominant player
Yeah.
in the market.
They've had to reinvent themselves over and over, but they've done it
And
successfully.
that's the key to a great business. If a great business has got good management and they've got longevity and staying power, they can reinvent themselves or they can shift, they can make changes. And they're big. It takes a while, but they can do it.
When you guys look at some of your, your single stock ETFs that you guys choose to create products around, are you looking at, management and you're looking at how they're guiding the company and you're putting a huge focus on that? Or it's more so you guys look at, earnings, the structural business, things like that?
We look at all of those things, but we also look at, from the standpoint of the single stock, what are the larger, more dominant, more topical stocks that are out there? Why are they there? Why is the market sort of gravitating to these companies? And that's a very big, important part of market or say performance over time.
Yeah.
There's a lot of we love Strategy Corp or MicroStrategy. What Mike Saylor's doing there,
right?
But he has his opponents as well. He has his naysayers as well.
Yeah.
But if his underlying philosophy is the growth of Bitcoin and the demand for Bitcoin over time, we'll continue to push it further up.
That makes sense. Yeah.
And we concur with that philosophy, and therefore we want to own that stock.
Mm-hmm.
And we own it in some of our funds, and we also own it as a single stock.
Right.
So it's a great way, we think, to sort of have a play from a corporate standpoint on Bitcoin.
So very American focused, but you mentioned Canada. What are your guys' thoughts on Canada in the future? Right? Like I know, it's. I feel like I'm a very, I find myself being very heavily exposed to the United States. But do you think? Are there any stories that you're watching right now in the Canadian economy where you're excited about, where you're thinking there's a huge source of growth?
Well, Canada. I'm a Canadian. I love Canada. Canada needs more customers.
Yeah.
Right.
Yeah.
What business out there, if you think about put it as a business, if you have 75 or more % of your business with one customer, it's not a good long-term philosophy, right? Yeah. And that's sort of showing up now with the Trump administration and the tariffs and the stresses they're putting on our auto sector and so on. I think we have to go out and get more customers. And that's, I think, the benefit, the long-term growth story for Canada. And whoever's in power, and presently it's Carney, you've got to really focus on how do we develop those international markets? How do we take our huge resources that we have here? And I'm sure everyone's seen all the sort of comparisons of how Canada could be 10 times wealthier if we used our resources properly all the time and sold them.
I hear it from my father-in-law all the time. He's just always all the time.
So we need more customers. Yeah. And there's huge customers in China and India and Asia. We could get our resources out to them. So we've got to work together as a nation and our provinces to get those resources out to the rest of the world. Yeah. Because we've got great potential customers. And I think that is what excites me about Canada. We may have to go through a transition, but I think that's the long-term growth for this country.
I do. I definitely, we're very resource rich and we have great talent here. And even the brain drain problem, I think about like how that's going to be addressed and things like that. But it is interesting to see, like, there has been some tech investments. Toronto's becoming a great tech hub and things like that. So I'm quite bullish on Canada because I think we have so much potential. But just taking it back to,
we've got a great educated population. We've got great people here, great technology. We have resources. So we definitely have the ability. I don't just mean resources in the ground, but I mean just resources, just general, brain power, university system, educated population. We have great people here. So that's really what's going to drive it.
And the other thing is,
but we have to get along and we have to make things happen.
That's right. And it is an advantage just being so close to the United States. And like, we need to leverage that more, in my opinion.
Yeah. And we've been a big beneficiary of that for the last 125, 35 years.
For sure.
Big beneficiary of it.
Absolutely. But yeah, what I was going to say was, just thinking about Harvest and the business in general, you've been through several market cycles. What are some things that, just struck, like, just more business wise, just running a company through multiple cycles? And then I guess, how do you balance running the company and then running the actual investment philosophy and things like that? And is there ever any tension around that?
No, there's no tension around it. We've got a great investment team. We have one of the top equity option writing teams in Canada. I think it's probably the most tenured in Canada now because we managed to bring a couple of great people on board. Through cycles, you really always have to take a long-term view because even in running Harvest, and I talked to my CFO, I said, we have to make sure that if the markets drop 30%, we're fine.
Yeah.
Right.
Totally.
So, because at some point it will happen.
Mhm.
And, we've got sort of a great business, a great employee body. We've got a great investment management team. So we just stay focused and we continue to build over the long term. And you have to, we've had great markets recently, and these pullbacks we have seem to be short lived. But at some point, these things can be 6, 12, 18 months long, and they're painful.
Yeah.
They're hard to get through.
Yeah.
But we've been through them, and you just have to stick with it. Stick to your philosophy. If you like what you own, then why sell it?
Exactly.
Right? And one thing about being a business owner is you look at businesses a bit differently, because if you really like a company and you see their stock's down and their earnings are down, but they haven't lost their focus and they continue to be a leader in their space, well, just continue to hold on to them.
Yeah.
Because you should, over time, it should skate out and do fine.
It's funny you say that, because I used to so in my early to mid 20s, I'm in late 20s, so it's not that much later, but but I started to get the thought of like an exit from a business was so just attractive to me.
Mm-hmm.
And it was, I got to figure out a business that I can do and I can exit and I could sell and make a bunch of money, whatever. And then I realized over time, like the real game is, building a business that you would never want to sell.
Mm-hmm.
And like, that's the place you want to be. So I guess, when you think about Harvest and how you're building it and into the future, like what are the things you're most excited about that make you think, hey, like this business, I would never want anybody else to own this but me, and whatever. Like, what's making you really, really excited in the future?
Well, you're a 20-something. I'm a 60-something. Let's start with that.
Fair.
Maybe your horizon is a lot longer than mine, but you're absolutely right. First of all, when you sell a business or you sell a stock, you've got to go find another way to invest that capital and grow it at the same rate or better.
Mm-hmm.
So first of all, you're gonna have to pay taxes when you sell a business, and then you got to take that net tax amount and how do I keep compounding that at the rate I was before?
Mm-hmm.
If you've got a great company or a great business or a great investment and it's growing at a good clip, just continue to sort of nurture it, take care of it, and grow it, right? And that's really what it comes down to. So personally, I have a long-term view to this company. It's been 16 years. I hope we're still 16 years from now continuing to run.
Yeah.
And that's my long-term philosophy.
Yeah.
So stick with it. If you've got a good thing going, keep working with it.
Yeah.
And I know I have friends that are entrepreneurs and they buy and sell businesses all the time.
Yeah.
And it's great to get the cash out. But at the end of the day, if you're compounding at a great rate, how else can I compound at a faster rate? And if I can't, I stick with what I'm doing.
I find it funny because, it's like you'll see these entrepreneurs, they'll exit a business and then they'll just throw all the money into a different business. Yeah. And it's sort of like, well, if you really like the original one and it's serving your life well, then, what's the I don't know. Anyway, I'm good.
Well, you have to look at the industry too.
Yeah.
And I mean, there's a lot of people that get into different businesses or restaurant businesses and so on, and they get them popular and they sell them. But, the investment management business, the ETF business particularly, is growing at a very quick compound rate of over 20%.
Mm-hmm.
It's one of the top 10 businesses on the planet right now.
Mm-hmm.
When you look at overall growth. So if we're in a great growth industry and we're growing faster than an industry, why would you want to get out of that industry?
Yeah,
right?
No, exactly. I guess, Michael, this is literally like the last question. I've really enjoyed chatting with you. Just sort of around the excitement thing, like from an investment philosophy perspective, what are the things that you and the team are most excited about in the next 5 to 10 years with markets? Like what do you guys, when you look forward in the future, like what are the things that are like, wow, like obviously we talked a lot about AI and obviously technology and things like that. Is there any sort of broader thing that makes you guys excited to come to work every day?
Well, we're excited about the markets, and I wouldn't be here if I didn't love stock markets.
Yeah.
And I've always been, I'm 100% in equity.
Yeah.
I've always been my whole career. I've always believed in a long-term growth philosophy. And that's the philosophy of Harvest. I mean, we see what's happening in AI. We have the largest healthcare fund in Canada. I think maybe even in the US too, if you look at income generating products. Mm-hmm. I think AI is going to benefit healthcare. I mean, healthcare is going to become an even more dynamic industry.
Absolutely.
As time goes on. So I'm excited about everything going on, right? So
fair.
It's we're in a great business. We're growing. We're always looking for new ideas that we can take to the market and grow products with and get investor interest in. If we can't find ideas, we'll continue to work with what we have already in our sort of quiver, if you will. Right. Cool. So it's great. So we continue to grow, and hopefully we're here for many more years.
I'm sure you will be. But yeah, thank you so much for coming on. I really appreciated it.
Thanks for having me. Appreciate it too.